Have you ever wondered why, when markets crash or stocks plummet, the wealthy seem to grow even wealthier? The truth is, while the poor panic and sell their assets in times of crisis, the rich are quietly buying. Why? Because they understand the power of opportunity in times of fear. The market has a rhythm. It goes up, it goes down, but those who can keep their cool during the downturns are the ones who reap the rewards when the market bounces back. In the world of investing, timing isn't about waiting for the perfect moment. It's about understanding the cycles and using volatility to your advantage. For most people, when they hear about a market drop or a bear market, they see it as a sign of doom. But for the experienced investor, it's simply another chance to buy undervalued stocks and build wealth over the long term. You don't need a fortune. To start, just the right mindset and a strategy to guide you through the ups and downs. So, how do you make that shift from reacting with fear to seizing opportunities? How do you transform into someone who buys when others sell? This guide will show you the mindset, strategies, and tips that the wealthiest investors use to build and protect their fortunes. By the end of this, you'll understand why the poor sell and the rich buy, and more importantly, how you can adopt that same elite investor mentality. Many people end up buying stocks without truly understanding what they're buying. They see the price drop and rush to invest, thinking that the lower price is a great opportunity. However, when the stock price continues to fall, panic sets in, and many investors end up selling at the wrong time. To avoid this, it's crucial to understand what's behind the stock, the company's business model, its profit outlook, and the fundamentals supporting its operations. It's not enough to look at the price. You need to analyze what that price represents in the long run. Investing without understanding the company is like buying a car just for its color without checking the engine. Imagine you're interested in a tech stock, but you have no idea how the company makes money. You could be buying into a company with high levels of debt, which could affect its future profits. Understanding the company's fundamentals, such as its balance sheet, corporate earnings, and financial health, is essential to ensure that your investment is genuinely a great opportunity. Understanding the company doesn't happen overnight. It's a process of analysis and research. Before investing, look into financial reports like the income statement and familiarize yourself with the company's strengths and weaknesses. By doing this, you'll be better prepared to identify opportunities and avoid market panics that can lead to impulsive, harmful decisions. Long-term investing requires patience, careful analysis, and the discipline to stay calm during periods of volatility. Over the past 93 years, there have been 50 instances of 10 corrections and 15 times when the market experienced a 25 drop, known as bear markets. This shows us that the market will inevitably face declines. However, it's equally important to recognize that the market always recovers. Understanding this natural cycle is key to surviving and thriving in the world of investing. If you're not mentally prepared for downturns, investing in stocks may not be for you. Corrections and bear markets are part of the financial ecosystem. They create periods of volatility, but they also provide opportunities for those who know how to navigate them. The market's recovery after a significant drop can be swift, and often the best time to invest is when fear and panic are driving prices lower. Investors who remain calm during these times can capitalize on the correction by acquiring stocks at a discount. The market's ability to bounce back is one of the reasons why investing in stocks is one of the most lucrative strategies for long-term wealth creation. It's essential to keep in mind that short-term declines are not indicators of failure, but rather signs of the market's normal cyclical behavior. The key to being a successful investor is understanding that both bear markets and corrections are temporary phases in the market's long-term upward trajectory. By embracing this mindset, you can approach market downturns with confidence and make informed decisions that will pay off when the market begins its recovery. If a stock was attractive at 14 and then drops to 6, it could present an incredible opportunity for those who understand the company and the market. When prices fall, many investors panic and sell, but this creates the perfect chance for savvy investors to buy at a lower price. As long as you've done your homework and you trust the company's fundamentals, market drops are not something to fear, but something to embrace. This is where you can make the most of your long-term investment strategy. For example, let's say you've been eyeing a company with strong fundamentals, but its stock price takes a hit due to market volatility. Instead of running from the drop, you can use this correction to purchase shares at a discounted price. Smart. Investors recognize that the market's short-term fears do not always reflect a company's true value. If the fundamentals remain solid and the long-term prospects are strong, this drop can be a golden opportunity to buy in before the price rebounds. However, timing is crucial. It's important to remember that while price drops can signal a good opportunity, they can also be a sign of deeper issues within a company. This is why having a clear understanding of the company's balance sheet, debt levels, and overall health is essential before making any purchasing decisions. By focusing on a company's long-term potential, rather than reacting to temporary fluctuations, you'll be able to take advantage of drops without falling victim to the panic and fear that often grip the market. It can be tempting to buy a stock simply because its price has dropped significantly. Take, for example, Polaroid, whose stock price fell from 130 to 18, or Kaiser Industries, which dropped from 26 to 3. Many investors believed these stocks were too cheap to ignore, only to see their investments continue to plummet. The truth is that price alone is not a reliable indicator of value. If you focus solely on price movements, you risk investing in companies with weak fundamentals or unsustainable business models. It's important to remember that a low price doesn't necessarily mean a good buy. A sharp drop in price might be a signal of serious underlying issues, such as poor management, declining sales, or high levels of debt. Without understanding the fundamentals of the company, such as its earnings, balance sheet, and debt levels, you might be setting yourself up for a loss. This is why relying on fundamental analysis is crucial. Only by evaluating the company's health, prospects, and strategy can you make an informed decision about whether the stock is truly undervalued or just a sinking ship. Successful investors look beyond the price tag. Instead of focusing on a stock's recent price movement, focus on the long-term potential of the company behind it. A great way to do this is by performing a thorough fundamental analysis, examining the company's revenue growth, profit margins, and balance sheet. With a solid understanding of the company's core business and financials, you can make smarter investment decisions that go beyond the panic-induced reactions that typically drive stock prices down. Peter Lynch, one of the most successful investors of all time, embraced market volatility as it creates unique opportunities. He often used the example of Taco Bell, whose stock dropped from 14 to 1 before being bought by Pepsi for 42 per share. For investors who understand the market's cyclical nature, such volatility can be a blessing in disguise. Price fluctuations that seem alarming to some can represent an opportunity to buy undervalued stocks or to adjust your portfolio for better future growth. While volatility might feel unsettling, it's an inherent part of investing in the stock market. Markets go up and down, sometimes dramatically, and these shifts can be caused by anything from economic news to political events. However, this doesn't mean that you should panic or try to time the market. In fact, embracing volatility allows investors to pick up stocks at more favorable prices during downturns. When you have a long-term perspective, these price swings become less about fear and more about finding opportunities. For investors who are properly prepared, market volatility can actually increase their potential for higher returns. Stocks that drop in price may not be doomed forever, rather, they might be temporarily underpriced due to market sentiment. Understanding the causes of volatility, staying informed about the market, and trusting in your analysis of a company's fundamentals will allow you to make sound decisions even when market prices are in flux. Remember, volatility is just another part of the investing journey, and those who can handle it with confidence are often rewarded in the long run. Historically, the stock market has proven to be one of the best investments over the long term. The value of stocks grows as companies expand and profits increase. Over an 89-year period, the market has historically doubled in value. This growth far outpaces returns from safer investments, like money in a savings account or fixed income securities. While stocks can be volatile in the short term, their long-term performance tends to outperform many other investment options, making them an ideal choice for building wealth over time. The key to capitalizing on the stock market's potential is understanding that patience is a virtue. While bonds or savings accounts may offer more stability, they also come with lower returns. Stocks, on the other hand, offer higher potential returns, but they require a long-term mindset. Over time, companies grow, and their stock prices generally reflect that growth. This means that staying invested in the market, even through periods of downturns, often leads to strong returns once the market recovers. It's essential to remember that short-term market fluctuations are normal, but the market's upward trend over the long term is reliable. Investors who can ride out the short-term volatility are in a much better position to benefit from the market's long-term growth. The more you invest and the longer you stay in the market, the better your chances of seeing substantial returns. The stock market offers a unique opportunity to accumulate wealth through the power of compound growth, making it an essential part of any long-term financial strategy. Many investors claim they are in it for the long haul, but when the market dips, panic often sets in, and they make rash decisions. The key to successful investing is maintaining a long-term perspective and sticking to your strategy, even when the market experiences downturns. Remember, the market will have corrections and bear markets, but they are temporary. If you allow short-term fluctuations to dictate your actions, you could end up selling at a loss and missing out on the market's eventual recovery. True long-term investors have a different mindset. They focus on the fundamentals of the companies they invest in and ignore short-term noise. While others might be caught up in the daily ups and downs, they stick to their investment strategy, knowing that their investments are backed by solid companies with growth potential. Staying disciplined and not reacting emotionally to market changes is crucial for long-term success. Instead of selling out during a drop, use it as an opportunity to add to your positions or reevaluate your portfolio. Building wealth through investing is a marathon, not a sprint. The market will go through cycles, but history shows that it tends to rise over time. Investors who stay committed to their long-term goals and avoid knee-jerk reactions to market volatility are typically the ones who see the best results. So, the next time the market dips, remember that your investment strategy should be rooted in long-term thinking, not short-term reactions. Now that you've learned how the rich think and act differently from the rest when it comes to investing, it's time to reflect on your own strategy. Are you letting market drops scare you? Or are you ready to see them as opportunities? The next time you see a dip in stock prices, think about the long-term picture. Will you panic and sell? Or will you take advantage of the opportunity to buy while others are running for the exits? Investing isn't about avoiding risks, it's about understanding them, managing them, and using them to your advantage. Remember, the market rewards those who stay disciplined and stick to their strategies, even when the world is in turmoil. So, take a deep breath, stay focused on your goals, and start building your wealth like an elite investor. If you're ready to transform your financial future, don't forget to subscribe to the channel and turn on notifications. We'll guide you through The next steps to becoming a smarter, more confident investor. The journey starts now.